Hello everyone. Let us start with our seminar. Today we are going to cover several topics, several exercises which will come up in the exam.
So it's very, very important. And most of these exercises will carry a lot of marks as well. So I really want you to be able to do all three of them to score these marks in the exam. Okay? Hands up if you've tried to do these exercises at home, if you've attempted them. 1, 2. Okay, good. It's better than in other groups because some other students didn't even bother to look at this. What I would suggest, you need to try to do them at home before you come, because strictly speaking, you won't benefit fully unless you attempt to do these exercises yourself. Your brain works in two types of modes, I would say, in a passive mode and active mode. When you come to the lectures, your brain just absorbs information and you can understand everything. And it's a common problem with students. They come to lectures, they seem to be able to understand all my explanations, but when I ask them to do an exercise, they have no idea how to start. Because the brain, in order to start solving an exercise, the brain needs to work in a different mode. The brain needs to start producing information, which is totally different, totally opposite to what you used to do. That is why it is important that you practice, even if you won't be able to do a single exercise. At least you will start establishing this pathway in your brain, which will help you to solve questions in the exam. Because in the exam, you won't need to just look at the solutions and agree with it. And you won't need to understand the solution. You will need to produce it. And you'll need to train your brain to be able to do it. That's why please try to do these exercises before you come to seminars. Okay? And of course, I will explain everything. So let us start. Today's topic is supply and market equilibrium. We'll start with the easiest bits, shifts in the supply curve. Just a quick revision of what we have covered previously. So we've learned that supply curve is an upward sloping line because it shows the supply relationship. It shows that when prices go up, suppliers are happy to supply more units. We've also learned that supply curve shifts due to various factors, in particular costs of production, costs, technology, technological changes, expectations, and economic government policy. These are the main factors which will shift supply curve. But it's slightly easier compared to demand because most of these factors can be converted into effect on costs. So for example, better technology implies that your costs of production are lower. You will be able to produce more, quicker, cheaper, better, more effectively with lower costs. So better technology implies lower costs. Government policy, taxes and subsidies imply that if you are taxed, you will need to pay additional expenditure on top of your normal cost of production. So on top of covering your cost of materials, labor, you will also need to pay some amount to the government. This is what tax is. So basically increasing taxes implies increasing costs of production. So all of this can be converted into effect on costs. When costs are higher, it implies that we will be able to supply the same quantity as before, but at higher prices. So point A on the supply curve will shift upwards to point A prime. We will be able to sell the same quantity as before, QA, but now at a higher price, because the costs are higher. And this will be true for every single point on the supply curve. Regardless of how much we used to produce, small amount or large amount, we will need to sell the same amount at higher prices. We will need to pass at least some of these additional costs on to our consumers. If we cannot do this, if we don't want to increase the prices because maybe competition is strong or because we don't want to reduce our market share, we will need to cut down production. We will need to reduce quantity produced at the previous prices. If we have to remain at the same price level as at point A, we will need to cut down production. We will need to produce some smaller quantity because it's not profitable for us as before. We will need to switch our resources towards more profitable activity because we are in business to earn money. And if we cannot earn money with our previous product, we will need to start doing something else. So as a result, when costs increase, we will need to start producing some different product and reduce production of this one. Right, so this is what happens to supply curve. So when cost of production increase, our supply curve shifts upwards, up to this new level, shown in red. Quite messy, but it's not very convenient to write on this screen. But I think you've got the idea, right? And similarly, when costs of production drop, it implies that we will be able to reduce the prices and or expand production levels. And this will be true for every point on the supply curve. And as a result, supply curve will shift downwards or to the right. So this is what we need to know about the supply curve shifts. And now we are going to answer a few exercises, a few questions based on this. So exercise 1, how will the market supply curve of a good shift in each of the following cases? So this should be easy for you now. Cost of producing the good fall. When costs of production are lower, it implies that we are facing exactly this situation. We will be able to cut down prices and or increase production levels. So supply curve will shift to the right. So we can select right. Yes, right. Okay, alternative products and supply become more profitable. Let's imagine that we are a furniture manufacturer. We used to produce two types of products, desks and chairs. And desks, for example, which was our main product, now is less profitable compared to chairs. An alternative product, chairs, is now more profitable. How will this affect production of desks? It will reduce because chairs, we used to produce 50-50. And now one of the products become more profitable. We will switch our production towards this product with a higher profit margin, and we will cut down production of desks regardless of the original price. In other words, our production of desks will now be lower. Supply curve will shift to the left, closer to the origin. We will need to increase prices of these desks to maintain our profit margin, or will produce less of them. So exactly the same situation which we used to have already. We'll need to increase price of desks or cut down production because it's not profitable. It's not as profitable as before. And as a result, our new supply curve will now be located higher. In other words, it shifts to the left. So if I will go back, it will move to the left. Got this? Yeah. Next question. The price of the good rises. What will happen? Any ideas? Absolutely right. No shift because there will be a movement along the same supply curve. So if we sketch a graph, we are simply moving along the same supply curve. Price of a good goes up and our quantity goes up, quantity supplied goes up too. So we are moving along the same supply curve. Excellent. Firms discover more efficient technology. More efficient technology implies that we can produce the same amount but quicker and cheaper. It's equivalent to lower costs of production, which will increase supply and shift supply curve to the right, as we've covered previously, to the right. Government introduces a tax on suppliers. This is an additional cost for us. It implies that we'll need to cover an additional expenditure. Let's imagine that we produce our desks. We work operate at point A. This is our supply, price, and costs. We used to sell, let's say, 10 desks per day. We used to sell them at £100. And out of these £100, let's say 60 was the cost of production. This is price. This is cost, £60. So this is cost of production. And we have a markup or profit of £40, which we put on top of the costs. And then government introduces a tax of £20 on our products. What does it mean? It means that on top of this £60 of costs, we'll need to pay 20 more pounds, which will leave our bank account. We will need to cover this too. In other words, we will need to increase the prices at least by £20 to protect our profit margins. And this will be the case regardless of our production levels, whether we produce 10 desks or 1 desk or 100 desks. In any case, our supply curve will need to shift upwards. If we cannot do this, we will need to cut down production because again, we will switch to the production of chairs. So basically, taxes is the equivalent of an additional expense, higher cost of production, which implies that our supply curve will shift to the left or upwards. So these are the correct answers for this particular exercise. Any questions? So basically, these are the simplest ideas regarding determinants of supply and how it will shift supply curve. Let's try to do one more exercise and then we will proceed to the most difficult questions. So another exercise, how will the following changes affect the market price of wheat flour? So we've covered this exercise previously and there were different events which affected demand. Now we're talking about different situations which will affect the supply side of this market. For example, bad weather leads to bad harvest of wheat. Bad weather. Okay, bad harvest of wheat. Wheat is used in the production of flour. In other words, we have less wheat in the market available, which means that we might have problems getting our supplies, getting our resources. There is less availability of wheat. It's likely to be more expensive. It's difficult to source. It might disrupt our supply chains, which means that it's likely to increase cost of production. I'll just try to explain this graph, which is readily available. So higher costs of sourcing wheat, which is a resource for us for the production of flour, implies that our supply curve will have to shift upwards from this blue line towards the red line. The most important thing is how will it affect equilibrium. Basically, in economics, we use graphical analysis a lot. What we do, we try to come up with the ideas for various curves. We try to understand how to plot a curve which describes certain relationships. Then we shift these curves, which will allow us to determine how a new equilibrium will be established. And then we will be able to analyze what happens along our axis, how changes in the market will affect our variables in question, in this case, quantity and price. So why do we need to shift supply and demand curves? Because we want to figure out how these changes will affect price and quantity. So in this particular case, we move in equilibrium from this blue line towards the red equilibrium, where the original demand crosses the new red supply, which means that our price will move from P1 to P2, higher price now, and quantity will now drop. These changes in these variables is the main target, is the main reason why we are doing this analysis. We wanted to figure out how this will affect the market. That's how price will be higher, quantity will be lower. Next question, the discovery of a cheaper way of milling flour. Better way of doing things implies better technology for us. Technology is equivalent to cheaper costs of production. This will shift our supply curve downwards. So our supply curve, original supply curve used to be S1, blue line. Now it's shown by the red line S2. As a result, equilibrium moves from this blue point towards the red point, which means that our price is now lower. Price drops from P1 to P2, and quantity will now be higher. Quantity increases from Q1 to Q2. This is the result of these changes in the market. So we are mainly interested in the effect on our variables on price and quantity. And we can analyze these effects simply by shifting demand and supply curves. And you can apply this analysis to any market. As I mentioned previously, you can analyze changes in wage rate, for example, and unemployment level. You analyze labor market. So what you can do, you can draw demand and supply diagrams for the labor market, and you can analyze the effect of government policy on the wage rates. For example, we can have the price of a product here along vertical axis as before. What is the price of labor? It's the wage rate, the wage. Quantity of labor of our product along horizontal axis. What is quantity of labor? It's the employment level. It shows how many workers will be working in how many workers will be purchased by companies, because we as workers, we supply our labor ability to work to the labor market, and companies hire us. They purchase our labor services. So employment level, quantity of labor in a market will determine how many people will be able to get a job, how many people will be hired, how many hours per week they will be able to work, how many jobs are available for us, right? And we will have demand for labor, again, downward sloping, because the higher the wage rate, the lower company will want to hire us. If it's expensive for companies to hire workers, if the wage rate is, let's say, £50, it's expensive. They won't want to hire many low-skilled workers at this very expensive wage. Instead, they will try to replace them with some equipment, with some machines. If you if you consider how supermarkets looked like 20 years ago, we didn't have automated self-checkout points. We've always had cashiers, till operators who used the checkouts and who processed our purchases. But as wages increased, it became cheaper for supermarkets to install self-checkout points. So they pay for this equipment once, and they avoid paying high wages to their staff. So basically, if our wage rate is too high compared to the value which we can create for the company, they will replace us with machines. And number of staff purchased will be relatively small. Demand will be small if wage is high. But of course, supply curve for labor is upward sloping, supply of labor, because the higher the wage rate, the more incentive we have to work. For example, if wage rate is very low, let's say £2 per hour, what incentive do you have to work? How many hours will you be willing to work at this low wage? maybe you couldn't be bothered at all. Maybe you won't work at all. Or maybe some teenagers will work for a couple of hours per week just to earn some pocket money to spend on ice cream. And the amount of labor supply will be relatively low. Let's say out of the whole city, there will be 2 people who are prepared to work at £2 per hour. Well, if I offer you £50 per hour, apparently there will be maybe 1,000 people who are willing to work at this going wage rate. So supply relationship shows absolutely the same idea which we've had already: upward sloping supply, downward sloping demand. And equilibrium in the labor market will determine equilibrium wage rate, which will be in this market, for example, £12 per hour. And this will allow us to hire, let's say, 600 workers or 600 work hours per week in this particular society, this particular village or city or whatever, right? And the same model will allow us to analyze various events in this market. What if the government introduces the new minimum wage law? How will it affect our market? Let's say government, who is populist government, claims that they care for working population and they want to increase the standards of living. They want to provide a new high living wage. So they want to eliminate poverty in the society, and they are going to force companies to pay us higher wages. Wouldn't this sound nice? Yeah, it sounds nice in theory. The problem is when government tries to interfere with the functioning of the free market mechanism, it frequently does more harm than good. For example, when the going wage in the market, equilibrium wage rate is £12, and the government forces companies to pay us £50, it will create equilibrium. So what will happen in this particular market? If the wage rate is now shown by this new blue line, I'll draw it in blue, new minimum wage. At this wage rate, we will have quite a lot of people willing to work. So there will be 1,000 workers or job candidates or people who search for work, search for jobs. There are 1,000 workers available on the market. While at this very high wage rate, there will be, let's say, only 2 vacancies in the market. There will be 2 companies who will be prepared to pay £50 to their staff, and apparently they will select staff with the highest skills possible, which means that there will be 1,000 candidates searching for jobs, competing for these 2 vacancies. These 2 people will be hired, so this is our quantity demanded, jobs available, 2 people will be hired, and this is quantity supplied, the number of candidates available. 2 people will be hired, and the rest will become unemployed. Unemployment level. It's a new unemployment which was artificially created by the government. What is unemployment? Unemployment is a situation when we have a gap between quantity demanded and quantity supplied, when there are some people on the market who are looking for jobs but cannot find them because there are no jobs available for them. It's excess supply in the market. It's a surplus of labor available on the market compared to demand. So basically we've created artificial unemployment. And now even these people, not even this, sorry, not this, these people. Previously, we had 600 people who had jobs. Now, 598 people out of this lost their jobs. They were quite happy to work at £12. This paid their bills. They were able to purchase food for their children. Now they can't, because they were dismissed and replaced with machines. So basically, this model, demand and supply model, allows us to analyze different markets. We can similarly analyze demand and supply in the forex market, foreign exchange market. We can predict changes in foreign exchange for different currencies. For example, as before, we have price and quantity along horizontal and vertical axis. Price of a good which is sold on this market is price of the currency, price of the British pound, for example. Exchange rate is the price of a currency in terms of another currency. So basically here we'll have an exchange rate of a British pound. Exchange rate. And this is quantity of British pounds sold in the market. And as before, we'll have demand, which is downward sloping demand for British pounds, and we'll have supply of British pounds available on the market. And equilibrium in demand between demand and supply, point where they cross, will determine equilibrium exchange rate in the market. And number of pounds sold in the market or traded in the market in a particular day. When there is increase in demand, for British pounds for whatever reasons, maybe because investors want to buy shares of British companies, they come from abroad, there is lots of foreign direct investment which flows into our country, they will need to exchange their own currencies into pounds because they want to buy shares of British organizations, British companies, they will need British pounds for this. In other words, this will increase demand for British pounds. It will shift demand curve upwards. New demand for pounds will be higher, which will push the exchange rate of a British pound higher. Pound strengthens, it becomes stronger, it gains value because it's a popular currency. Everyone wants to hold pounds to be able to spend it within British economy, right? And of course, this will increase quantity of pounds traded in the forex market. So basically, you apply the same idea to very many different markets. It's very, very simple, but very powerful tool. Got this? And now we proceed to slightly more complex questions, which all of you will get in exams. Let me just open this. Let me skip question 3 for now. If we'll have time, we'll cover this. This is not difficult at all. Here we just shift different curves and see what the result will be. For now, I want to focus on this exercise 4. All of you, if you're making notes in your seminar workbooks, could you please put an exclamation mark next to this exercise, exercise 4. All of you will get this type of exercise. Do you have your workbook? Did you receive your workbook last time? You've got this. Okay, has everyone received their workbooks? So put an exclamation mark next to this question 4 in market equilibrium topic. You will get this. Every single student will get different questions. Obviously, you will get different numbers, different formulas, but the type of question will be this one. So yes, it's topic market and equilibrium, supply and market equilibrium. Yes, exercise 4. Yeah, which page is it? 12, page 12. So on page 12, exercise 4, put an exclamation mark next to this one. So you will get this type of question in the exam. Every single student will get different formulas for demand and supply, and every single student will be asked to calculate equilibrium price and quantity based on this description of demand and supply relationships. I will show you how exactly to do it, and you simply follow the same procedure. Normally, this question is worth about 2 marks in the exam. What do we have here? We have 2 formulas which describe demand and supply. These are 2 formulas which I'm going to rewrite on my OneNote to be able to use them. So our demand is described by that formula. Quantity demanded is equal to 120 minus P. Supply relationship is described by another formula. Quantity supplied is equal to 5. How do we know that this is demand and supply relationships? Because they show the relationship between quantities and prices. As price changes, quantity will change too. Here, the relationship is negative, which means that the higher the price, the lower the quantity will be. It's the demand relationship, negative relationship. Here, in the supply, the higher the price, the higher the quantity will be. It's a positive relationship, right, which shows upward sloping supply curve. So here, what do we need to do? We'll need to calculate equilibrium price and equilibrium quantity. How do we do this? We simply need to solve this system of simultaneous equations. Why is that? Because if you sketch demand and supply curves, supply, demand, quantity, price, this is our equilibrium point E, equilibrium price, P star, equilibrium quantity, Q star. We know that equilibrium is the point which determines quantity where quantity demanded is equal to quantity supplied. Equilibrium is the point, it's such a price which clears the market, which ensures that quantity demanded is equal to quantity supplied. Or if you think about this differently, equilibrium point sits on both demand and supply curves. It's a point where they cross, so it belongs to both curves, which means that this combination of numbers, equilibrium quantity and price, satisfies both equations. It can be described by both equations together simultaneously. So to find this point, you simply need to solve this system of simultaneous equations. And now you can proceed solving this system using any mathematical method which you've learned at school. Or you can think about this differently and use an economics approach instead. So you can do it purely mathematically or as an economist. So step 1, write down, if you work as an economist, write down equilibrium condition. What is an equilibrium condition which describes this equilibrium? Basically, in economics, if you need to find any equilibrium, just write down equilibrium condition first. There will be a formula which describes this equilibrium condition. In every single model, in every single theory, write down equilibrium condition. In our case, it's this condition: quantity demanded equals to quantity supplied. We start here. Step 2, plug in the numbers. Plug in values for quantity demanded and quantity supplied. It's very simple. Quantity demanded is shown by our formula. It is 120 minus P. That's our quantity demanded. Here it is. What is quantity supplied? It's 5P. That's it. And now we have an equation with a single unknown which we can now solve. In order to solve an equation, obviously, we move all terms with variables to one side and all terms without variables, just numbers, to another side of our equation. And of course, as we move one variable to another side, it changes the sign. So minus P becomes plus P. If you struggle with this bit, if you don't understand what I've just done, it implies that you will need help with your mathematical skills. You will need to revise how to solve equations. And for this, you can access the Center for Academic Success. If you go to ICT and type in Center for Academic Success, it will take you to their web page with their contact details. You can book a one-to-one tutorial with them. It's free. You can book a tutorial with the tutors who will help you to cover any gaps in the previous knowledge. We cannot cover all school math here at university. We assume that you have this knowledge, but if you struggle, we have support available. They have trained tutors who are very experienced in helping our students to catch up and cover any gaps in knowledge. They will help you. So if you don't understand what is happening here, just take your notes, book a tutorial, come to them, and they will explain you. So you can literally point them, I don't understand this bit. They will explain how it works, and they will help you to learn how to solve equations. They can help you with other study skills, not just with math and statistics. They can help you how to understand graphs, how to plot curves, how to interpret the slope of the curve. If you don't know what a derivative is, for example, you can go to them, they will help you. Or if you don't know how to reference properly for your essay, how to structure your essay, how to do an academic search, how to search for academic literature, go to them, they will help you. They will provide additional support in terms of the study skills. Okay, but for now I'm covering the economic part, and they can help you with any other study skills if you struggle with any aspect of this. I hope that you understand what is happening now. Now we continue with our equation. So 120 is equal to 6P, which implies that 1P is equal to 120 divided by 6, which is 20. In other words, and this is an equilibrium price, we can label it with a star because we found this number from a system of two equations. So we know for sure that this is an equilibrium value. It's 20 pounds. We found it from the intersection of two curves. And next step, step 3, is to plug this value for P star back to demand or supply equations to find equilibrium quantity. So our P is equal to 20, which means that quantity demanded will be equal to 120 minus P, 120 minus 20, which will be 100. Or we can plug it into quantity supply. Doesn't really matter. Whatever formula looks easier for you, use this one. It doesn't really matter. The result will be the same. So 5P, 5 times 20 will be equal to 100. And this is our equilibrium quantity, which is 100 units. 100. So these are our answers. Price is 20. Equilibrium quantity is 100. This is how you approach this exercise. Literally just equalize quantity demanded and quantity supplied and solve your equation. After you've got one variable, plug it back into any of the formulas and you will get the second variable. Very simple. You will get usually 1 mark for price and 1 mark for quantity in your exam. Okay? Any questions at this stage? Even if the formulas look differently, even if they are more complex, you still proceed with the same mechanism. You still follow the same steps. The solutions are available on Moodle. You will have the same result, the same procedure. Price is 20, That's what we've got, and quantity is 100. Answer D. And if you've been offered some options, you can obviously then find these numbers out of the set of options provided for you. Okay, next question. Which of the following is true if price is equal to 15 or if it's equal to 25? Could you please, these questions, could you please put another exclamation mark next to these two questions, 15 and 25? Put another exclamation mark. It's another question which will come up in the exam. You will be asked to identify and calculate disequilibrium in the market, so surplus or deficit. So you will need to find the size of this deficit or surplus and define what exactly it is. Is it excess demand or excess supply? Right? All of you will get this in some form or another. So let's have a look how it will work. So we have two possible prices which differ from equilibrium. We have price equal to 15 and price equal to 25. So let's do them one by one. So this is our equilibrium situation, demand and supply. Demand and supply, they cross at the point where equilibrium price is 20 and equilibrium quantity is 100. The question is, what will happen if price is equal to 15, which is lower than equilibrium price? In other words, what if we are located somewhere here along this blue line? Obviously, because our price is not equilibrium price, there will be some disequilibrium in the market, and this disequilibrium can be shown by this distance between quantity supplied and quantity demanded. Quantity demanded is determined by this point, let's call it point X, and quantity supplied is determined by point Y on the supply curve. Right? Quantity demanded will be relatively high because price is low. Grab a seat, please. And quantity supplied will be relatively low because suppliers don't have an incentive to produce as much as before at this low price. We'll need to identify the size of this deficit. How do I know that this is deficit? Because we have so many consumers and only so few items available for them. There is more demand compared to supply available, which means that some of the customers will have to go without this product. They won't be able to purchase this product. Let's calculate the size of this deficit. To do this, plug in the values, calculate quantity demanded and quantity supplied from formulas. What was quantity demanded? Quantity demanded was described by this equation, 120 minus P. P is 15, which means that our quantity demanded is 105. In other words, there is 105 customers who want to buy the product, whatever this is, books, chairs, computers, whatever. What is quantity supplied? Quantity supplied was described by this equation, 5P. 5 times P, which is 15, implies that quantity supplied is 75. In other words, we have 105 customers who want to buy 75 products which are available, which means that we have a gap, the difference between them, which is 30 units. 105 minus 75, 30 units. This is the size of our disequilibrium. And what sort of disequilibrium this is? This is deficit, 30 units. It's a shortfall or shortage or deficit of 30 units. 30 units shortage. We're short of this product. It's a deficit on the market. So this is how you solve this question. Okay, what if the price is now different? What if price is now higher than equilibrium? We will be somewhere on this green line. But as before, we will have a disequilibrium because quantity demanded will be determined by this lower number. Let's call it, I don't know, point M. High price, relatively high price, relatively few customers. So quantity demanded will be relatively low, while quantity supplied will be determined by this point. Let's call it point L. It will be relatively high because price is relatively high. Suppliers have high incentive to sell, to offer more units. Let's calculate this. Quantity demanded when price is 25 can be calculated as 120 minus P. P is 25, so it's 120 minus 25, which is 95. So now we have 95 customers who want to buy products on the market. Quantity supplied when price is that high is different. It's 5P. This is the formula which describes this relationship. P is 25. So 5 times 25 is 125. So again, there is a gap in the market, but now it's excess supply. It's a surplus. It's a surplus of products in the market. There are 120 products available, but only 95 customers, which means that the difference, the gap, will be also 30 units, but difference between different numbers now. So it's 30 units gap, and now this is a surplus because we have too many items available and too few customers to buy them. So again, 30 units, but this is a disequilibrium of a different type. It's a surplus now. If price is higher than equilibrium, there will be a surplus. There will be too many unsold items because the price is too high. If the price is too low compared to equilibrium, there will be a deficit in the market. There will be too many buyers willing to buy these cheap products and not much available for everyone. Got the idea? So this is the second question, which you will definitely get in the exam. Could you please put your mask on top of your nose if you don't mind? We need to keep each other safe, please. Yeah, we are doing this for everyone, so let's just keep everyone safe. Any questions regarding this? Right, so if you return back to our exercises, then you will just need to find the options, the correct option. So in the first case, you are offered this combination of answers, possible answers. When price is too low, there will be a deficit. So you can have a look at the answers which contain shortage. So B and D are the possible answers, and we've managed to calculate it. That's why the correct answer will be B. This will be the correct answer for this. And when price was too high, it means that there were unsold products. So we've had excess on the market, a surplus, and it happened to be 30 units. So for first exercise, the correct answer would be B, and for the second one, it's A. And this is how you solve it. And again, in your solutions, there is full explanation available. That's how you do it. So if you need to revise this, you can always come back to this. Okay, so we didn't have a break, so I think we have about 20 minutes left, maybe, yeah, about 20 minutes left. What I will do, I will go through this question 8, just go through these explanations, and then we'll answer any questions which you might have from this or from previous topics. Because question 8 explains some issues which some of you may struggle with. So let's open question 8. Let's look through this first. Could you please read through this, and I will try to answer what difficulties you might get there. So we are talking about market for education, for higher education. Market for education. Like any market, it can be analyzed using demand and supply curves. So there will be some downward slope in demand and some upward slope in supply. There will be price of education, which is tuition fees, and there will be some quantity of education or units of education purchased, which can be calculated as number of students enrolled onto various courses. There will be some equilibrium point in the market, which will determine equilibrium price of education, equilibrium tuition fees, for example, £12,000 per year, and certain number of students who will enroll, let's say 100,000 students per year. Market for education, right? So what happened here during the last 4 decades? The real price of college education increased. College education means university education because this comes from the American textbook, and they call their universities colleges frequently. So price of university education increased, but they still led to increase in the number of student enrollments. So the question asks you what particular scenarios could have led to this result. Increasing price, yet increasing number of students still enrolling on courses. Let's go through this one by one. And as you will see here, there might be some ambiguities in our answers, and I will explain you how to deal with them. So let's have a look at first possible option. Answer A. A shift to the right in the supply curve and shift to the left in the demand curve. Demand and supply. Original equilibrium. Original price. Original quantity. So supply shifts to the right. New supply. And demand shifts to the left. Okay, our equilibrium will now be located here at new equilibrium, blue equilibrium point, which implies that our price have dropped. New price dropped and quantity has increased. But please pay attention. I've deliberately drawn shifts in the demand and supply curve differently. So in our case, a supply curve has shifted by a large amount while demand shifted by a little bit, and this led to this result. What if our demand and supply curves will shift by different amounts? So let's imagine that we are still charging the same original price and the same original quantity. So our original equilibrium is still at the same point E1, but we shift demand and supply curves by different sizes now. What if our supply curve now shifts by a little bit? They still shift in the same direction, it still shifts to the right, and demand curve still shifts to the left, new demand curve, but they shift by a different amount. Then our equilibrium will move to the green point equilibrium, which means that our price will drop and our quantity will drop. And now please pay attention. Price drops in both cases. An ambiguous drop in price. It drops for sure in any case, regardless of how you shift the curve. However, the effect on quantity is ambiguous. We don't know what happens to quantity in this case, because we can move to a point which is located to the right of the original equilibrium if the shift in the supply curve is relatively large. Or we can move to a new green equilibrium point, which is located to the left of the original equilibrium, right? Which means that quantity will actually reduce. We don't know. This depends on the relative size of the shifts. It depends on which curve shifts by more. If they both shift by the same amount, our equilibrium will be located directly underneath point E, which means that there will be no effect on quantity at all. So there are three possible scenarios with quantity. It can increase, it can drop, or it can remain unchanged. And we don't know which one is exactly the case. What we know for sure is that price is guaranteed to drop, because regardless of the relative size of the shifts in demand and supply, both of these shifts will lead to lower prices. So please pay attention. In your exam, there might be some questions about this. When you are dealing with two shifts in both demand and supply, there will be a definite effect on one variable. Definitely, there will be a certain effect on one variable, but uncertain effect on another one. Don't immediately assume that quantity will remain unchanged, because they won't necessarily shift by the same amount. You can be dealing with ambiguity here. And after you've discovered this, you can check the answer, the actual exercise. The exercise tells you that the shift to the right in supply demand curve, shift to the left in demand curve for college education should have resulted in a higher price, higher tuition fees, and higher enrollment. So now let's check whether this is the case. Price is now lower, not higher. This is what we are expecting to explain. This is what we need to explain. But with this scenario, with what we've covered with part A, we know that this will lead to lower prices, not higher prices. With quantity, it can increase. We don't know this, but price definitely won't go up using this scenario, which means that A is incorrect, and we can eliminate this solution out from the possible options available to us. A is incorrect. Cross it out and move further. Next possible explanation. Again, let's draw it. And now I'll even draw three cases to make it easier for you to follow my logic. We'll start with the same original amount, the same original equilibrium, some original price P1. In all three cases, original equilibrium, black equilibrium. We'll use colors because I think it's just quicker and easier to understand. And original quantity Q1 in all these scenarios, Q1, demand 1, demand 1, demand 1. Of course, it's important to label the curves correctly, because if you make mistake here, the answer won't be correct. Now, what we have here, shift to the left in the supply curve, supply shifts to the left in answer B, and demand shifts to the right. But of course, they can shift by different amount. So let's just start. Supply shifts to the left. Let's draw a small shift to the left first. In first case, it will be a small shift. In the second case, it will be like medium shift, and in the third case, it will be a large shift. All shift by the same, by different amounts. Demand curve shifts to the right. As before, let's draw demand shifting by high amount, by medium amount, new demand, and by small amount. Can this happen? Of course it can. So we have three possible cases. And now let's find where our equilibrium will be located. Our new equilibrium will be point E new, blue equilibrium. new, E, new. And now let's analyze how this will affect our variables. Let's analyze our variables. So what we can see here, price has increased, quantity dropped. Price has increased, quantity no change. Price has increased, quantity increased. So as before, we have unambiguous effect on price. Price goes up in all scenarios, but effect on quantity is ambiguous. It can increase, it can drop, or it can remain unchanged, depending on where our new equilibrium will be located, depending on the relative size of these shifts. And now, after we've got this solution, we need to compare this with the options available, with what was asked. In the actual question, we've been asked how we can explain increase in the price of education and simultaneous increase in quantity. Can this scenario explain this outcome? Yes, it can, because we can be in this particular situation when supply shifts by little bit and demand shifts by more. And this particular shift, or set, a combination of shifts, will lead to our possible outcome. It will lead to our situation which we are trying to explain. This particular model, this particular graph can explain exactly what has happened in this market for education. So yes, B gives us a possible explanation. It is one of the possible answers. Not in every scenario, but it can explain what has happened. Simply because demand has increased by more than supply. Yes, supply is more scarce, but demand has increased by so much that in spite of higher tuition fees, students still want to enroll on courses because you want to benefit from increase in your further earnings, lifetime earnings, and as a result, you enroll, even if it's costlier. Option C, shift to the left in supply curve. Supply shifts to the left, while demand shifts to the left too. Let's just check. And again, I think I'll draw 3 cases to make it easier to understand. I won't save any space, but original equilibrium, black equilibrium. I'll use color coding to make it quicker. Won't label anymore. So that's original scenario. Supply shifts to the left, small amount, medium amount, large amount. That's our supply. Demand shifts to the left too. Let's say it shifts by large amount, medium amount, and small amount, but it shifts downwards. New equilibrium, blue point, and this blue point. So what conclusion can we make regarding these changes? Price has dropped, quantity has dropped. Price unchanged in this scenario, in second case, quantity dropped. Price increased as we move to a new equilibrium, quantity dropped. So what we can see, quantity always drops in all scenarios. It always declines due to this combination of shifts. All of these shifts, lower quantity, lower demand and lower supply will lead to lower quantity sold. But the effect on price is ambiguous. We don't know. It can drop, it can increase, can remain unchanged. We don't know. So, but in any case, we can make a conclusion that quantity will be lower because both shifts and both demand and supply will lead to lower quantities. But we've been asked to explain increase in price of college education and increase in enrollments. Here, enrollments are actually declining. That's why it's not what we need. And this combination of factors couldn't explain what has happened in this particular market. So C wouldn't be correct. We need to eliminate this. And answer D, none of the above, wouldn't be correct because we did have a model which has explained our scenario. We did come up with a solution which was plausible. So that's why we can eliminate D. And as a result, we are left with the only possible correct answer, which is B, is the correct answer for exercise 8. So please pay attention to this exercise because it illustrates another issue which you can experience with demand and supply curves in your exam. There might be some ambiguity. Don't necessarily assume that all shifts are of equal size. It's not always the case. Okay, any questions regarding this? Next time, please try to do these exercises at home and come to me with questions. So if some questions are easy, it makes no sense spending time on them in classroom. So I would rather focus on more difficult questions where you truly struggle and explain them in more details. I think it will be much more useful for your exam preparation. In the exam, there will be different questions, different level of difficulty. Some will be easy and some will be more complex. So it will be easy to pass, to score some easy marks. But if you want to get a first, you will need to be able to do more complex, more difficult exercises. But of course, if you learn how to do difficult ones, you will cope with the simple questions. Okay, any questions? Let's have a look at exercise 3 in market equilibrium. First, rise in the cost of refining petrol, increasing costs. When costs of refining petrol go up, just 1 second, let me just have a look. We are talking about demand for and supply of petrol. So this is a market of petrol we are considering. It's important, right? And we'll need to figure out where we will be located, market for petrol. Due to various changes, market for petrol. When costs of production go up, what curve will it be affected? Demand or supply? Who will be affected, consumers or producers? When costs of refining petrol go up, it will be more expensive for producers to keep producing as much petrol as before, which means that it will be an effect on the supply curve. If there was a certain supply curve 0, this is where we've started, and costs increase, it means that any previous amount which we used to offer, any previous original quantity, will now be sold at a higher price. Suppliers will need to pass this extra cost on to consumers, at least partially, because otherwise they won't be able to keep producing the same amount of output. They have an incentive to increase prices for their goods, which means that every single point on the supply curve will shift upwards due to higher costs of production, and supply curve, the whole supply curve, will shift upwards. So in our situation, when we experience a rise in the cost of refining petrol, supply curve shifts upwards. Our new supply curve will be shown by this dotted line S2 to S2, which means that our equilibrium will move from point X to point H. This is where we will be located. Our demand curve is still shown by the original demand curve D0, but our supply curve is now shown by this higher dotted line, S2 in this case, right? And as a result, our answer will be point H. This is where we will be located. Next, fall in the bus and train fares. Fall in bus and train fares or prices. In other words, this is a drop in price of substitute product. Why is it a substitute? Because we can travel by car or by public transport. When we travel by car, we pay for petrol. The cost of travel depends on the cost of petrol, right? When we travel by bus, we pay for bus ticket. So strictly speaking, when petrol becomes very expensive, we can switch away to using public transport because it becomes cheaper. And the other way around. When buses become very cheap to use, it means that it's relatively cheaper to travel by public transport. So cheaper travel by bus, not by car. As a result, this reduces usage of cars drops, which means that demand for petrol drops as well. Demand for petrol drops. So if we were originally located at some demand curve D0, now, because it's cheaper to use buses, demand for petrol will drop. We'll switch away from using private cars to using buses. As a result, new demand will be lower. And now we'll need to have a look at where our new equilibrium will be located. Our new demand curve, if we originate at point X, supply curve is not affected. We are still on supply curve S0, but demand now is lower. It shifts from this thick line D0 downwards towards this dotted line D2. So our new demand will be shown by D2, new demand D2, demand curve D2, which means that our equilibrium moves from point X to point F, and our new equilibrium will now be located here, point F. Therefore, new equilibrium at point F. If this was our supply, for example, this was our original supply curve, so we shift from point X to point F, X to F. Next questions are slightly more complex because we have two factors, two changes, fall in price of crude oil and increase in price of cars. So let's write down what they mean. So fall in price of oil And in addition, we have increase in the price of cars. So two effects. So let's go one by one. When price of oil becomes cheaper, it makes it cheaper to produce petrol. Cheaper to produce petrol. Costs drop. Do you agree? Yeah, when oil is cheaper, it reduces cost of production of petrol, and as a result, supply curve shifts downwards or to the right, in this direction, to the right. So if we sketch a graph, it will look like this. We used to be located at the original point, original supply S0, original demand D0, and now, let's use the red line, supply curve shifts downwards. This will be our new supply. Shifts in this direction, downwards, cheaper. Next, when price of cars increases, cars and petrol are consumed together. These are complementary goods. Price of a complementary goods increase. When it is expensive to use cars, people will buy less cars. Demand for cars will drop. Quantity demanded will drop. People will buy less cars. And as they buy and use less cars because they're so expensive, they will need less petrol. So demand for petrol will drop too. In other words, demand curve shifts in this direction, downwards to the left, lower demand, because people don't need that much. New demand will be lower. So demand curve shifts downwards and supply curve shifts downwards too. And as a result, our new equilibrium will be a point where these two new lines will intersect. So we'll move to some point lower. So let's have a look at the original graph. We used to be located at point X. Now demand curve shifts downwards to line D2 and supply curve shifts downwards to line S1. So we move from point X to point E. So this is what we will experience. We'll move from X to a lower point E because it's an intersection of lower demand and supply. So this will be point E. New equilibrium, point E. That's a solution to this exercise. Okay? So you just analyze both effects separately and then combine them together and find a new equilibrium. You start with an original equilibrium, shift various curves, think how they will shift, find a new equilibrium, and then you will know what will happen in the market. And final one, what I asked, rise in tax on petrol, reduction in tax on cars, effect of government policy. Rise in tax of petrol, let me just rewrite this. Raising tax for petrol, this will be some effect, and reduction in tax on cars, lower tax on cars. So let's have a look what will happen in this market. Higher tax for petrol implies that suppliers will need to cover additional expenditure. On top of paying for refining petrol, on top of paying to their staff, they will also need to pay certain sum to the government. This increases costs for production, for suppliers, increases costs for suppliers. As a result, supply curve will shift upwards in this direction, shown by the arrow. It will shift up because it's more expensive. Reduction in the tax of cars implies that it will be cheaper to buy cars because government likes to collect taxes from various sources, and one of them is tax on consumption. For example, if you buy cigarettes, about 90% of the price which you pay is taxes. Same as alcohol. These goods carry quite a lot of taxes on them, and same for petrol. Quite significant proportion of the price which we pay is actually taxes. Suppliers don't get this money. So the same with cars. Government can decide to charge different tax rates on cars. We all pay certain taxes. For example, VAT tax, value added tax. Every single good which we buy, with just very small number of exemptions, will carry VAT. Taxes on the goods which we purchase. Usually it's around 20%. And 20% for a large amount, if you buy a car which is worth 30,000 pounds, 20% is 6,000. And if government decides to reduce this rate of taxes, it will lower the price dramatically for you. So when tax drops, it makes cars cheaper to buy. Cars become more affordable, which will shift the demand curve upwards in this direction. Demand curve will shift. Why there will be no movement along the same demand curve? Because price of cars won't be affected. It's the taxation which will affect consumers. Now they will be able to pay less, and as a result, demand will be higher. Using cars will become more affordable. They will buy more cars at higher quantities. So what do we have? If we combine this together, original supply 0, original demand 0. Now new demand is higher, and supply has shifted in this direction. So supply moves there, demand moves there, and our new equilibrium will be located higher than before. So it's a point above the original equilibrium. If we look at the graph, it will be this point. We move from point X to point A. So the answer will be point A. It's a point on the new higher demand and new higher supply. Answer would be point A. That's how you would tackle this particular exercise.